So real estate to me, guys, is a terrible investment. And before you start judging me, I want to say I own about $219,000 in real estate. Not just physical real estate like this one, but also, for example, into real estate investment trusts where I own parts of hospitals, parts of parking lots, and a whole bunch of real estate properties in a sense. But overall, I do think real estate in reality is a lousy investment. And in this video, I'm going to break it down. And yes, I know it makes it sound very sexy. When you hear about, Tommy, I can control an asset that's so expensive for a little bit amount of money. I can use other people's money. I can, for example, get some passive income. I can house hack. There are so many attractive, sexy parts when it comes to real estate, but I want you to watch this video with an open mind, because what I'm gonna break down in this video, it might change your mind. It might help you adjust your real estate plan if you're into that stuff. But overall, it's me telling you why real estate to me is a lousy investment. And again, I used to be very defensive with my ideas until I learned that's very stupid. Because whenever you're defensive with your ideas, you don't give the other person to give you new information to consider to then adjust your plan. If I stuck with my original ideas, I would be broke right now, because you have to become a learning machine when it comes to this game. So this opinion is my opinion right now. I'm gonna break everything down. It might help you adjust things, but overall, in a few more years, who knows, we might need to adjust it. Or you might know something that you wanna comment down below, and that might also help me adjust the plan, okay? So watch this video in totality to get the full message. As always, guys, do me a favor and smash the like button. On top of that, we have a goal, 500K by the end of the year, so go ahead and subscribe to the channel. Now, the very first thing is, guys, I firstly want to tell you exactly what I consider to be a good investment. To me, the most important thing to consider first is that I get a good return on my money. Meaning, for example, I want to make sure that if I'm investing my money into somewhere, I want to get at least 12 to 15% on my money. Now, that's based on basically what the Fed is giving me for risk-free as far as bonds, okay? Meaning, for example, if I go buy a 10-year treasury bond, I'll get like 2-3%. So automatically, my investment has to make me more than that, because that's risk-free. Plus, it has to make me more than what inflation is costing me, the taxes is costing me, and everything else involved. So that's why I like the figure of 12 to 15%. But obviously, if interest rates change, and that figure goes up from 2% to 5% or 6%, then obviously I'm going to require a much larger amount of money when it comes to my rate of return. Second, I want to invest into something that needs very capital to keep the business making more and more money. That means, for example, if I put my money, like Warren Buffett always uses this example here, if I put my money into a great business, for example, like See's Candy, which is a candy company in California that sells candy, okay? This company has a total amount of money that it needs to operate the business. But beyond that, whenever it makes a lot more money, and it increases prices, guess what? We get all that money in cash. Meaning, I don't have to constantly keep putting more money into the property, for example, to make me more money. For example, hey, it's looking outdated, gotta remodel. For example, hey, this broke down, gotta fix it. You know what I mean? It's kind of like the airline business where you gotta keep buying planes, because if you don't, it's a problem, right? It requires a lot of capital to keep it operational. Third, I think, okay, passive. I agree to basically put in a lot of work to find the opportunity, but once I find the opportunity, I don't want to have to put in a lot of work to actually keep everything consistent, okay? So overall, let's say I buy a stock and it takes me a lot of work to find this one stock. Maybe it took me 12 months, maybe a year, maybe 2 years, okay? But once I buy the stock, I can basically just sit down and wait, let the price go up, collect dividends, but I don't have to go clean any toilets, okay? Now, fourth, I want to play a game, and investment-wise, where I have a competitive advantage, meaning I'm better than the average person. Now that means in real estate, it's not like you can just be like, you buy any property and you're gonna make money. That's not true, okay? You have to know exactly what you're doing, like anything in life, okay? But there are a lot of people out there that are interested in the real estate game, okay? Now, that's what I consider an investment. Those are the most important things to me. And overall, to summarize it, it's just me wanting to get an appropriate return on my investments. wanting to keep making money without having to keep putting more money into it, wanting to make the money passive without working like crazy, and wanting to make sure that I have a competitive advantage over everyone that's playing the game. That's what I care about when it comes to making an investment. Now, number two, guys, here's what I don't like about real estate, okay? Now, the only way to play this game when you don't have a lot of money and your daddy's not rich is by basically taking on a lot of leverage and using OPM, other people's money. Now, in reality, if you have a property, this property costs $100,000. You don't have that much money, all you have is $20,000. You go to the bank, you put down 20%, they give you $8,000. In reality, you just got to control a $100,000 asset for 20% of what it's worth. So if you rent that out and get just $3,000 after you pay the bank or whatever, that's a 15% return on the $20,000 you basically invested. That sounds so attractive because in reality, you don't have to have a lot of money to get into the game. But again, the entry level to real estate to me is personally high because it's not just about, for example, a dollar amount. It's also about, for example, the amount of risk you have to take to actually get into the deal. Because the minute you have control over that property, you have control over the rents. Yeah, you make money, but you also have to control over everything wrong that happens with that property. And if people can't pay and you can't pay the bank, you're liable, okay? But it's unlike a stock. A stock, for example, I can go into the stock market and buy, for example, $1 worth of Walmart or whatever company I want to invest into. I don't have to require, for example, to get my credit check. I don't have to go, for example, and borrow money from my mom to do it or whatever. You could do things like that to manage other people's money or whatever, but it's not a requirement in a sense. But when it comes to real estate, to make it in real estate as far as investment-wise, you need to, in a way, use leverage. And you need to use OPM and other people's money. And you have to be very smart about this because guess what? Leverage increases the ability to actually get a higher return, but it also increases your risk. That is also a part of it that people don't really mention. And everyone talks about the successes, but what about the failures? There are a lot of people that go bankrupt when they do this stuff, okay? So be very careful. Now, number two is, guys, the money in real estate isn't made, for example, on the rents per se, and when you sell it. No, it's made when you buy the property. Now, this obviously means that in order to buy a property for less than it is worth, because that's where the money is made. Let me explain why, okay? If you buy a property for $100,000 and the property appraises for $100,000, right? You're not really making any money right there. When the rent comes in, you'll have a return on your investment, yes, but the real money is going to be made when you buy a property that's worth $100K for $50,000 or $70,000 or $80,000. And those opportunities are far in between. For example, one big opportunity was, for example, 2008, when you can buy real estate for quarters on the dollar. Okay, for example, you can find real estate for 80%, well, not 80%, that's a big margin, but like for 20, 30, 40, 50% off. Okay, that was a great opportunity. So whenever you bought into the property, automatically you had in built-in equity, and that is awesome. And on top of that, it also means that your return on the money you invested is also probably going to be a little bit higher because it requires less money. And the way you do this, I learned this from Dave Ramsey and also Meet Kevin when I was really involved into real estate. The idea is when you're looking for these properties, these opportunities do exist. You can go into a neighborhood where the average property sells for $100,000. You find a property that has some cosmetic issues, and then you say basically, hey, this one here is selling for $70,000. I can basically say, I'll spend like 10, 15K remodeling it. And then after that, I have literally like $15,000 in built-in equity into this property just by buying at a discount and fixing these cosmetic issues here and there. That's pretty cool. That's pretty awesome. But you see how it sounds? It sounds pretty good, right? But this also means you have a lot of competition because you also need to compete with everyone else that's looking for those deals. And that's with everything in life. But I'm just telling you guys, real estate is a much harder game than people let on to. And that's fine because the harder it is, the harder you work, the more it's probably going to pay off. But it's not as simple as it basically looks. Number three, upkeep is a real thing. Now, everyone talks about, for example, like house hacking. And people told me, Tommy, why don't you house hack this home, right? You're single right now. You can just, for example, go ahead and rent 2 other rooms here. You make some extra income. Or you can turn it into a 2-family house and maybe build a house on top or whatever. The answer is, the thing about house hacking? The answer is that the good thing is your tenant is right next to you, so they're right next to you. The bad thing is your tenant is right next to you. Okay, so even for example, if you're not house hacking, the upkeep is real. Real estate is something that needs maintenance. It's a physical asset. It deteriorates over time. Okay, so overall, you have a property over time, things are going to, for example, get outdated. So you will need to replace certain things. You will need, for example, to maintain the property overall. The upkeep is real. Now, if that doesn't bother you, having to wake up, go fix the toilet, having to answer this call and go do this, overall, you can always just build that into the entire rents. To say, for example, I'm gonna build this into the rent, that we can have a management company take care of this stuff. That's also a solution to this problem. Now, number 4, and the final one, guys, in my opinion, the return on your investment for the risk you're taking, it's not really that great versus what you can get out there. For example, if I can make a 12-15% return on a property, on the money I actually invested into the property, right? Cash and cash return. The answer is, it sounds very attractive, but I'm also taking a big risk on the actual management of the property in case anything actually goes wrong. But what I like most about, for example, stocks and investments is basically I can get, for example, a high return on my investments. And whenever the price goes down, as long as I understand my investments, the volatility is actually going to help me. But overall, in real estate, it's the same thing, right? Volatility helps you too. But overall, what I don't like about it is that basically you are taking a lot of risks to get this return that can always be, for example, taken away if things don't go your way at a certain point. And that's something I don't like. There's this powerful quote by Warren Buffett, and he says basically, when the tide goes down, you'll know who's skinny dipping. And it's very powerful because you have a lot of folks in real estate that make a good return. But if you have, for example, a few vacancies here and there, you have a bad market, maybe rents go down, the answer is you might have this massive issue. And you might not be able to keep up with everything that's required to maintain your payments. And that is pretty risky. So overall, guys, what am I trying to tell you? Okay, because even though I'm telling you all this, I also own around $219,000 in real estate. Now, overall, I do want to be honest, the return on this $219,000 investment is approximately about 4.24. What is it called? 4.24%. It's terrible, okay? I don't even want to remember it. But overall, what it does give me is flexibility, because the $119K that I have invested into this property saves me about $8,700 in rent every single year. And it also gives me a lot of peace of mind because I own this property. The other money I have invested between, for example, real estate investment trusts in the market, the answer is it's also a good source of dividends and also diversification as far as my investment goes for like full long-term retirement stuff, okay? So overall, it's actually pretty good for what I want to use it. Because although I get a terrible investment when it comes to the real estate money I actually have invested, it does give me a lot of peace of mind. So as far as, for example, having money invested into real estate to give me peace of mind to say my cost of living is very low, or I also have diversification with my retirement fund, that makes it worth it for me. As far as, for example, Tommy, how would you personally want to get into the real estate game if you had, for example, a bunch of money to put it inside? The answer is, guys, the reason I wouldn't put the money I have now into real estate is because I just feel like it's a crappy return overall based on what's going on right now. I'm not willing to take on a bunch of leverage, so it just doesn't make any sense. I could have $100,000 and buy, for example, 4 properties or 3 properties and have to manage those, have to get the rents or whatever. But then if things go wrong, I could potentially lose what I have, okay? That's the idea. And you could say, Tommy, well, that's not going to happen. Don't think negative. The answer is, it's just something I'm not willing to play. So that's why I won't play this game. But overall, let's say, for example, what would be my approach to buying real estate? Well, if I exhausted all other methods of making money the way I like making money, the idea is I would go about by saying, I'm going to put down 20% on this property, okay? It's a rental property. I'm going to try to buy it obviously below what it's actually worth. So this way I make money in the deal in. And then once I put down that 20%, I'm going to use the rents to pay the mortgage. I'm going to use my extra money to pay the mortgage. And hopefully between 5 to 10 years, that home is paid off. And then I'm going to buy the next home the same way with those rents plus my money, plus the other rents to pay that one off even faster. And whenever I buy one property, I want to make sure I have at least 3 to 6 months worth of all the expenses, just in case you have vacancies or you have issues with maintenance when it comes to the actual property. But this entire idea, it's a very conservative way to actually make money. And that's the problem. You see, I'll give you guys a personal example here. On Saturday, not this Saturday, next Saturday, I'm going to be looking at a property here in Puerto Rico. The sale price is about $100,000. The appraisal is $100,000. I'm not going to buy it for that price if I can't get a good deal on it. Now, I can basically make somewhere about $700 on this property potentially per month. Now, $700 per month times 12, that's about $8,400 a year, right? Not bad. Now, if I buy this property for $100,000, that's an 8.4 return. It's not that attractive for me because I also have to put money into the property to fix it up here and there. I have to make sure I maintain it. Well, what about the taxes involved here? What about inflation? What about if I discount it against, for example, I can get, for example, in bonds? The answer is, to me, it's just not an attractive return. I want to get at least 12%, especially when I'm putting like my money inside of it. So the only way I would buy this property, honestly, is if I got this property for $80,000 and instantly I got $20,000 in built-in equity, which is actually pretty cool. Well, automatically at an $80,000 buy price, I'm looking at a return of about like 10%, which again, it's not that great overall. You got what, 8,400, and I put in $80,000 into this property. The answer is my return. Why isn't it doing it properly here? I don't know why it's not. Yeah, there you go. It's about 10.5% return. That's not that bad overall, and it's actually pretty good. And I would do it. I would consider it, but I would want to get it even for $70,000 because $70,000 would give me, for example, again, 8,400 divided by $70,000 here. The answer is that will be a return of about 12%, and 12% to me is actually very attractive. But whenever you're putting so much money into real estate, the average is about like 7 to 8%. Okay, that's what it actually is. So I'm trying to get like a steal here, $30,000 in instant equity, along with, for example, like a really good return on the rents. That's pretty good. If I find a deal like that in real estate, I would instantly go for it because you have enough room here to make sure you can basically not have to worry about anything. And $700 extra is not a bad deal, okay, for $70,000 in perpetuity. That's pretty good. But overall, guys, that's my opinion, and that's why I would not put a lot of money into real estate per se, but I do use real estate, for example, for my personal property, and I also use real estate, for example, for diversification. And this way, not everything in life is I put in $1, I want to get $1 back or whatever. It's not that, because if it was all about investing a return, I would have never paid cash for this house. I would have grabbed this money, get a 45-year or 100-year mortgage, okay, just by refinancing over again, and basically just like extend it forever, right? Forever, and just use that money to invest it. But that's not the overall idea, because by me having this home and feeling secure, the answer is I'm able to operate in the marketplace with a lot more confidence and take advantage of opportunities when they actually come. So having this cash in this house enables me to potentially get a bigger return when I'm making my investments elsewhere. That's the idea. Not everything is 1 + 1, okay? Guys, thanks for watching this video. Comment down below, let me know your thoughts, and comment down below real, so I know you made it all the way to the end of the video. Not real as in R-E-E like the Instagram thing, but real as in real estate, okay? R-E-A-L, okay? My spelling can be off sometimes, but not this time. Thanks for watching. As always, like, subscribe, hit the bell so you get notified. Comment down below. Up here is another video. Over here is my face. Let's subscribe. And as always, long-term team officially out. If I had a way to buy $100 million worth of real estate, once you get to that amount of money, and single family homes at an effective rate and manage it correctly, it would be great. But what's the way right now?